What's good, everyone? Today we're breaking down Netflix using my three-step formula. If you're serious about building generational wealth, this video is for you. This is the same exact three-step formula I use to buy every single stock in my portfolio. And by the end of this video, you'll know exactly if Netflix is a buy and how to analyze any stock yourself. Let's get started. Netflix ticker is NFLX, and the current stock price when I made this was $100 per share. And this is all Q4 2025 after earnings data. Current portfolio update. My portfolio is up 97.94% year to date. So basically 98%, and we're killing the S&P 500 right now. So step one, I always check the market move. What does that mean? Let's go into it. All right, so I have a quote here by Warren Buffett. Be fearful when others are greedy and greedy when others are fearful. So why did I put that here? Because my whole mantra for buying is buy when we're in fear. Buy when the market's in fear. Buy when people are in fear. You know why? Because everyone's selling. That price is low. That price is undervalued. And I'm stepping in to buy. So first thing I'm checking is the Fear and Greed Index. You can find the Fear and Greed Index on CNN.com. Under Fear and Greed Index, you could Google it. It'll take you right to it. And it's basically a meter measuring where the market is right now, right? The market mood. So from 0 to 100, 0 being extreme fear, 100 being extreme greed. And like I said in the quote, I'm looking for fear. So my strong indicator is fear, weak is greed. What is the current value at this moment in time when I'm looking to buy Netflix? At 24, extreme fear. I'm looking to buy. Basically, I let extreme fear, when it's this low, trump all my other values, but let's still go through it. Next thing I'm looking at is the VIX, which is the volatility index, and this is basically just measuring market volatility. Again, I'm looking for a high volatility because that's unstableness. So when we're in low volatility, which is under 20, as we see here, the market is very stable, calm. I don't want that for buying conditions. For selling, yeah, that's perfect. But when we're looking to buy, I want instability. Current value of the VIX is 16. So that's low volatility. It's not the best when I'm looking to buy. And last thing I look at is the put/call ratio. And this is basically telling us how many puts are being bought in the market versus how many calls are being bought in the market. Again, the traditional desire would be for puts to be low, calls to be high, because that means the market is increasing. And that's good when we're looking to sell our positions. But for buying, I'm looking for it to be bearish, and I'm looking for a high put to call ratio. So what I've noticed through my own observation is 0.8 being that indicator line. So above 0.8 is when I start to see bearishness in the market, and that's when I'm looking to buy. Current value is 0.52, so we're more bullish. But like I said, when I'm looking into that extreme fear gauge, I'm pretty much trumping the VIX and the push/call ratio. And then I dump all this information into my market move calculator, and it will tell me the signal of what I'm going to do. So when you dump in those values, 24, 16, and 0.52, my signal is a strong buy. So like I said, that extreme fear is basically going to trump the VIX and the put. This is my market move calculator, and if you go on my website, JLaley.com, you could purchase it there. This is what I use every single time I'm looking to buy stock. Step two, analyze the fundamentals. Let's jump into it. First thing I'm looking at is earnings per share, which is how much earnings a company is making per share. And I'll explain that a little more in a second. But the EPS I want to see is greater than $4 per share. Netflix EPS 2.4. So we're neutral. It's not horrible, it's not weak, but it's not as strong as I would like it to be. And then the earnings per share 3-year average growth rate is basically a accumulation of 3 years, how much it's been growing, and it's averaging that out over 3 years. I want to see that above 15%. It is at 29%, so that's excellent. So why do we want a certain EPS? Well, let's break it down mathematically. So example, company A has an EPS of $5 and company B has an EPS of $1. Earnings per share. I own 10 shares of company A and I own 10 shares of company B. Which company, based on this data, is making me more money as an investor? Or making the company but me more in the long run as an investor? Well, simple math says company A is making me $50 because I have 10 shares with $5 per share. Company B is only making me $10. Company A is making more money. This is why we pay attention to earnings per share. Now that is not going directly into my pocket, but this is just a good perspective to put it in as to why you're looking for these numbers. Next thing I look at is shares outstanding, which is the amount of shares a company has issued. So right now, number of shares outstanding for Netflix is 4.2 billion. What we're looking at more so is the direction. We want the shares outstanding to be decreasing over time. And Netflix direction is decreasing, which is strong. This is good. Why are we looking at that? Well, let's explain it again with math. Say Netflix has 1,000 shares and I own 10 shares of that. I only own 1% of this pie. That's not that much. 1% of anything is really not that much, generally speaking. Now imagine Netflix is buying back shares. So now there's only 100 shares issued. And I still own my 10 shares. I own 10% of that piece of pie. That's a lot bigger than 1%. And that's why we want decreasing shares outstanding. Revenue, pretty self-explanatory. This revenue equates to sales. 43.4 billion right now for revenue. And again, 3-year average growth rate is just the average growth per year over 3 years. We want to see that above 10%. That's going to be my strong standpoint. Current value is 29%, above 10%. I love it. Next thing we're looking at is free cash flow, which is the cash that Netflix is holding. So you can look at it like your paycheck, right? So you have your pay, and then before it gets even direct deposited into your account, the taxes come out. So you have your pay, then the taxes come out, then you get your direct deposit. Then from your direct deposit, you're paying your rent, you're paying your groceries, whatever other bills you have, and then you're left with your cash that you can do whatever you want with. Same thing for the company. That's what the free cash flow is. You want to see a growing free cash flow. Right now, the free cash flow is 9 billion. We'll use that later on in the DCF model when we're calculating the shares value. But that's just a good number to hold on to. 9 billion is the free cash flow. What we're looking at right now is the growth rate. We want to see a 10% or more growth rate for Netflix, and we have 132%. 132% is amazing and great for what we're looking at right now. So what we're looking at for buying, we're loving this, but this is unsustainable. 132%. The likelihood of it progressing 132% every single year over year is extremely low. So we're not going to really take this at face value, but we're just going to look at it and say this is great. Free cash flow margin is just it's just the margin. So if you wanted to say X% would be how many cents per dollar of free cash flow it has. We want to see greater than 15%. We're at 21%. Great. Price to earnings ratio or PE ratio. This is a popular metric. I actually don't take it into a huge weight when it comes to determining whether or not I buy, but I do look at it. What we want to see is it under the industry average PE. So PE is basically telling us, is this stock or this company undervalued or overvalued compared to its industry, right? So Netflix will be in Netflix industry. Disney would be in there. Uh, Netflix is communication, so I want to say the phone companies are also in there, but that might not be the industry. But just for to put it in perspective, Hulu, Peacock, Disney. These aren't all publicly shared, but so you understand what industry is. It's comparing it to everything else in that bucket. So what we want to see is Netflix equal to it or under the industry PE. So industry PE is 17. We would want Netflix to be 17 or under. Netflix is 40. So Netflix is overvalued if you're looking at the PE ratios. Like I said, I don't have this extremely weighted in my decision, but I do look at it. Last thing I look at financially is the debt. Why is this important? I mean, we can translate it back to real world. Like I said, if you're in piles of debt from school, car, mortgage, you know how hard it is to climb out of that. So it's important that we look at the company's debt as well, because again, it's going to be hard to climb out of that if you're not generating, or if the company is not generating a good amount of free cash flow. Current debt 14.5 billion. We want to look at how long it will take to pay off this debt. Translating that back to the free cash flow it's generating. I want to see this under 2 years. And Netflix is at 1.61 years. I like it. All right, step 3, confirm with valuation. So now I want to calculate how much is this company's stock actually worth right now, regardless of where the market has it priced. What is it actually worth using financials? So we're using the DCF model, which is the discounted cash flow model. So we're taking the cash flow. This is why I said cash flow value was important. So we have our cash flow, that's $9 billion. Margin of safety. A margin of safety is basically your buffer. I mean, anything you do, you could put in a buffer, right? But I just know that the likelihood of it hitting the same exact percentage value every year is unlikely. So I want a buffer. So I'm going to buy even more undervalued than it already is. So then I have a higher chance of profitability as we start growing and the stock starts growing, right? So the current margin of safety I used for this one is 40%, which translated back into decimal will be 0.6 because you're minusing it from the 100. I use a couple different margin of safety values. I use 40%, 60%, and 10%. Growth metric, you want to use the free cash flow through your average growth rate, but that one was at 132%. And like I said, I'm not going to take that as face value because that's just extreme growth and it's very unlikely that it will happen again. I'm going to use a more safer value, which is 60%. So not only did I just cut the actual value in half, I added an additional margin of safety. So this is basically to protect myself and give me the highest probable chance of profit. Discount, 8%, that's a standard, 8 to 10%. Terminal growth rate, 3% is a standard value. And shares outstanding, which we talked about, 4.2 billion. And all these values will be calculated to determine that share price. So first thing we do is calculate free cash flow. So you're using the free cash flow value. This is the equation. If you want to plug it in, you can do it yourself. After plugging in all the numbers, we come out to 41.87 billion. Present value means you just calculated the projection, and then present value would be translating it back. After all the calculations, you get 28.48 billion. We're going to do the same exact thing with terminal value. Again, here's the equation. You're projecting. This is the value you get, 862.52 billion. And present value would be translating in the back. And then lastly, we're going to take those values to get the equity value. So we're adding the present value for both of those to get 615 billion. And last but not least, to get the actual intrinsic value, you have to divide by the shares outstanding. And we get $146 per share is what the actual price of Netflix is using those values. And like we said in side one, the current share price is $100. So what does that mean? Netflix is currently $46 undervalued, according to these numbers and these calculations. So the last thing, I liked it. I liked how it was undervalued by $46. Extreme fear. I like the fundamentals. Let's get into my position. We talked about the fundamentals and now we're getting into the technicals. I combine fundamentals and technicals to give me the highest statistical probability of success. We saw the portfolio RI. That's all I'm gonna say. My buy zones are the 200 moving average and the 400 moving average. And I have this displayed here. This is the red line is the 200, the blue line is the 400, and I have that green box showing you my buy zone. My entry was at the 200 moving average, so this red right here, and it averaged around $112 per share. That was my buy zone. And my target exit using the intrinsic value, I'm using the neutral intrinsic value. What is neutral? That was just my margin of safety. And that will be this yellow line right here. And that gives me a 27% ROI upside if it hits my target. And I gave you the exact manual calculations for this, but I do have a automated one because I'm an engineer and I coded it myself because it was taking so long to manually do this. So I do have an indicator that plots it for me. It plots all three margin of safeties for me. It also does my financials for me by color coding the candlesticks. This one right here is color coded red because of the EPS value was in the neutral. So I only have it showing green if it's in the strong categories. But you can tweak it if you want. You can also just manually look at it, which I did. I said Netflix is a good company, and I manually looked at the financials and decided I want to buy into that regardless. And so that's what I did. But if you liked this breakdown of Netflix, let me know in the comments, like, and subscribe. Thanks for watching.